right, as we've talked about this morning, the Federal Reserve standing pat on interest rates at its latest policy meeting, but internal projections now show the central bank's first rate hike could be sooner than we all thought. And any rate hike will be a critical development for the financial sector. Joining us now to talk about those stocks, Mike Mayo, senior analyst at Wells Fargo. Mike, good to see you this morning. Obviously, bank stocks reacted relatively positively to the news, although we're talking about maybe a rate hike in a couple of years. How does that filter into the value of bank shares today for you?
Well, inflation can be either heaven or hell for banks. And for the health scenario, we had to go back to the 1970s. I have my 1970s bag. And in there, I found a disco ball and some pretty bad inflation. So back in the 70s or even 1994, the inflation caused unrealized securities losses, derivatives losses, asset liability mismatches. So too much inflation is hell for banks. But we think what's happening now is a dose of heaven. And so higher rates sooner can allow banks to finally earn more money on all those deposits that they've gathered. And so this means that assets reprice faster than their liabilities. A bank like Bank of America has grown deposits equal to the sixth largest bank in the last year. And they spent a lot of money on gathering those deposits, branches and technology, sales and service, advertising, but they haven't been able to get the value for it because rates have been so low. Consider this. Over the past year, the decline in the bank industry net interest margin has been the greatest in a century. So if the Fed is going to raise rates, and as of yesterday, they gave an indication of 2 rate hikes in 2023, whereas before they had 0, then that should help reverse the decline in the net interest margin, help to improve traditional banking revenues, and give a tailwind to banks where they haven't had it. And as a reminder, you have not been at the start of a Fed rate hiking cycle in 6 years. And you're starting from a very low level of rates. So, yesterday was good news for banks. We think it's good news ahead.
Yeah, obviously on the credit side, things are going in their direction too. Consumers are flush, all the rest of it. What about the trading issues in the shorter term? Got some of the big banks warning things have slowed down in the second quarter.
Look, capital markets are still stronger for longer. Nobody expected capital markets to stay as strong as they were in the past few quarters. Corporations front-loaded a lot of their financing needs. But I still think, relative to where expectations were before, a lot of the banks were saying it's going to be like 2019. It's still going to be probably between 2019 and 2020. So that's still better than expected. And don't forget the biggest 2 positives for banks. Number 1 is credit quality. We now think that banks will release almost all of the reserves that they built up from the pandemic, and you should see that when they report earnings next month. And the other positive, it's imminent, is capital return. We think banks will return twice as much capital as the prior year after next week's Fed stress test. So we summarize all of this as 2-1-0 go for the banks, 2 times more capital return. The 1 relates to reserves going back to day 1 of the pandemic. And the 0, we think that banks increase deposits by 0% with the first few Fed rate hikes. And that falls to the bottom line, again, especially for a bank such as Bank of America.
All right, Mike, thanks for wrapping that up for us. B of A at 54 at yesterday's close.
Shepard Smith here. Thanks for watching CNBC on YouTube.